Hi, I'm Pattu from freefincal. One question I get asked often is what kind of debt mutual funds should we use for a long term financial goal? Of course, for a goal like retirement, most people would have mandatory fixed income products like EPF, VPF, then some people add PPF to it, and so on. But in addition to that, you may need a debt mutual fund for rebalancing, and of course there are other long term goals other than retirement. There are goals other than retirement where you would need a tax efficient fixed income product. So debt mutual funds do satisfy that requirement because compared to an equity mutual fund, which, I mean, if you look at an equity mutual fund, you have a set of stocks. If you have a demat account, you can go and buy those stocks, but you can't do the same with the portfolio of a debt mutual fund. It's not easy to do that. It's not easy to replicate a debt mutual fund. At least once, it's not easy to replicate a debt mutual fund. Therefore, they are a lot more valuable. Only problem is they have risks which we must understand, and there are circumstances which, like what happened with the pandemic and so on. So that's always there. But for short term goals, we have talked about this several times. Retail investors can simply stick to liquid funds and money market funds. Overnight funds also, but overnight funds is a bit of an overkill. You don't need that. Just liquid funds and money market funds are enough for all short term goals. Typically, the credit quality across all AMCs is more or less the same. So you can just, it's easier for you to choose your fund in this category. Ultra short term funds is not this is not true. There, the credit quality is a problem because some AMCs take on more risk than the others. So it's a problem for you. I would not recommend ultra short funds to new investors, to new debt fund investors. Now, for long term goals, I have talked about gilt funds many times. But some people ask, can I use a liquid fund or a money market fund for a long term goal also? Because they are scared of volatility. In a long term gilt fund, the credit risk is minimal. It's not zero because they up to 20% a long term gilt fund can invest in non gilt bonds, non government bonds, but typically they don't, but they can. So the credit risk is not zero, but it's minimal, but the volatility will be very high. We have talked about this several times. Longer the tenure of a bond, the more will be the supply versus demand forces in the market, and therefore more will be the price fluctuations. So some people ask, I don't want a gilt fund for a long term goal. Can I use a liquid fund or a money market fund? The answer is yes, you can. There is absolutely no problem with that. But the point is, if you embrace the volatility of gilt funds, if you get used to them over time, you can benefit from that volatility, like we shall see now. So this is a rolling return chart over 10 years. There are several curves here. The orange line is the Nifty 500 total returns index curve. That's the equity line that fluctuates a lot significantly. Then you have this white line here. That's the IBEX, that is the it's a gilt index. It's a gilt bond index, and you can see that also fluctuates, but not as violently, but it still fluctuates. Then you have the what do you call this? This is a burgundy kind of colored line, which is the CRISIL 1-year T-bill index. This is a treasury bill index, so it's the 1-year gilt bond index that approximately mimics the money market fund and the to some extent a liquid fund. Of course, liquid fund invests in bonds which are lesser than 1 year, but approximately. You can see that the returns, the 10-year returns of a gilt fund, the white line, is always above that of a 1-year T-bill index. So this means that if I construct a portfolio, let's say of 50% equity and 50% fixed income, if I choose that fixed income to be only this 1-year T-bill index, that is like money market funds or liquid funds, then my return will be a little lower than if I had chosen gilts for that fixed income. So you can see this blue line here is 50% equity and 50% gilts. The green line here is 50% equity and 50% 1-year T-bill. So if you embrace that volatility, if you get used to that volatility, do regular annual rebalancing, there's no need for any tactical play here. If you do that, then you will get a slightly better return than using a liquid fund or a money market fund for a long-term goal. So the volatility is there, but over the long term, the gilt volatility has the potential to give you benefits, and therefore I would recommend slowly getting used to gilt mutual funds. Don't invest in gilt mutual funds for a need you have over the next 3 years, 5 years, 7 years, and so on. Invest it for the long term. Invest it for retirement, which is like 20 years, 25 years away. Get used to it. Once you get used to it, then it's fine. In the case of NPS, government NPS, most of the money is in government bonds. Now, I have seen a bond crash in 2013 when the rupee strongly depreciated and the RBI had to increase overnight rates by 2% in a day. Then the bonds crashed because of that. That's another story. Maybe I'll talk about that later. At that time, the CAGR of my NPS became half. Something it was something like 11 and a half something. It became 6 or something like 6.5%. So it became almost half. That was a bit of a shock for me. So I got used to it over time, and today it's a little bit over. It has stabilized to some extent, and it's about 9.5% returns since inception. Since inception means since the time it became market linked. That is, NPS has been around since 2004, but if my memory serves me right, only since 2010 the corpus became actually market linked. That is, it became a debt mutual fund. So that's it for this video. If you have any questions, let me know.